Before you scroll away, before you assume this is just another gold or silver video repeating the same talking points, pause for a moment and really listen. Because what's happening right now inside the gold-silver relationship is not normal, not common, and not something that shows up during healthy financial periods. This is one of those signals that only appears when pressure has been building for a long time, quietly beneath the surface. While most people are distracted by noise, headlines, and short-term price movements, the gold-silver ratio is flashing a warning that has historically only appeared before major financial shifts. Most people don't even know what the ratio is, let alone why it matters, and that's exactly why it's so important. Because the biggest moves in history never happen when everyone is watching. They happen quietly, while the crowd is distracted, while confidence still feels intact, and while the system still appears stable on the surface. Right now, something is breaking inside the gold-silver relationship, and anyone paying attention should stop and listen. For decades, gold and silver have moved together like two gears inside the same machine. Different speeds, different functions, different roles, but always connected. Gold has always represented trust, stability, and long-term confidence. Silver has always represented activity, industry, and real-world economic function. When that relationship starts to fracture, it's never random, it's never harmless, and it's never small. What we're seeing now is not normal price action. This is not noise. This is not speculation. This is a structural signal, and if you understand what it means, you can feel the stress building underneath the global financial system. Welcome to Vault Stress Report, where we don't chase hype, we don't follow trends, and we don't react emotionally. We follow pressure. And right now, pressure is rising. Before we go any further, if you value calm, grounded analysis instead of emotional headlines and click-driven fear, take a second to hit like and subscribe. It helps this channel reach people who are trying to understand what's really happening beneath the surface, not just react to price spikes after they've already happened. You'll want to stay connected because the signals we're covering today don't appear often, and when they do, they don't stay visible for long. Now, let's slow this down and tell the story properly, because this is not a story that can be understood in a few sentences or a quick chart glance. The gold-silver ratio is one of the oldest financial indicators in recorded history. Long before stock markets existed, before central banks, before fiat currencies, and long before digital money, traders and merchants tracked how many ounces of silver it took to buy 1 ounce of gold. That ratio moved with trust, scarcity, and systemic stress. When economies were stable and systems functioned properly, the ratio stayed contained within a relatively narrow range. When systems cracked, confidence weakened, or monetary structures broke down, the ratio exploded. Think of the ratio as a pressure gauge rather than a trading tool. Gold represents trust, silver represents activity. Gold is held, silver is used, gold is stored, silver is consumed. Gold is insurance, silver is function. When fear rises, gold gets pulled out of circulation and locked away. When growth slows, industrial demand weakens and silver prices lag. The ratio stretches, and when it stretches too far, something always snaps. Historically, extreme gold-silver ratios have only appeared during moments of deep imbalance. During the Great Depression, when confidence in banking collapsed. During the breakdown of the Bretton Woods system, when the world quietly shifted away from gold-backed discipline. During the 2008 financial crisis, when leverage exploded and liquidity vanished overnight. During the 2020 global liquidity freeze, when markets seized and central banks were forced to intervene at unprecedented scale. Every single time, the ratio wasn't just reflecting metal prices, it was reflecting confidence breaking down. And here's the key point most people miss. The ratio doesn't move simply because gold goes up or silver goes down. It moves because capital is shifting between fear and function, between survival and growth, between hoarding and spending, between long-term trust and short-term activity. Right now, that shift is accelerating. Gold is being absorbed by central banks at a pace we haven't seen in generations. Not loudly, not with press conferences, not trending on social media, but quietly, steadily, and methodically recorded on balance sheets. At the same time, silver inventories are tightening across major exchanges. Industrial demand remains structurally strong. New supply is limited, and paper pricing mechanisms are being stretched thinner and thinner. That combination is rare, and it's dangerous. When the gold-silver ratio reaches extreme levels, history shows it doesn't stay there. It resolves violently. Either gold collapses, silver explodes, or the financial system forces a reset in pricing logic itself. And based on current conditions, one of those paths is far more likely than the others. Ask yourself a simple question. If gold were truly overvalued, would central banks be buying it with urgency? Would they be converting currency reserves into metal instead of reducing exposure? Would they be repatriating gold from foreign vaults back onto domestic soil? Would they be increasing gold's share of reserves while publicly downplaying its importance? The answer is obvious. Gold isn't expensive. Currency is weakening. Now look at silver. Silver isn't just a monetary metal or a speculative asset. It's an industrial necessity. Solar panels, electronics, medical equipment, defense systems, data centers, and AI infrastructure all rely on silver. You can't replace silver easily. You can't print it. You can't substitute it at scale without sacrificing performance, efficiency, or reliability. And yet, despite tightening physical supply and rising long-term demand, the price of silver remains suppressed relative to gold. That disconnect is the signal. It tells us the market is mispricing risk. It tells us paper leverage is masking physical tightness. It tells us the ratio isn't reflecting reality. It's reflecting distortion, and distortions don't resolve gently. Here's where the story gets more serious, because this isn't just about metals anymore. It's about the structure of the financial system itself. In every previous cycle, when the gold-silver ratio broke down from extreme levels, silver didn't just outperform gold, it shocked the market. It moved faster than positioning allowed. It forced short covering. It exposed leverage. And it punished complacency. Moves happened not because people suddenly became bullish, but because the system was structurally unprepared for reality. The people who benefited weren't the ones chasing headlines or reacting to price spikes. They were the ones who understood the signal before it became obvious. They were watching inventories, flows, ratios, and stress points while everyone else was distracted. That's why this moment matters. Right now, investors are trained to think in narratives. The tech narrative, the AI narrative, the crypto narrative, the rate cut narrative. But the gold-silver ratio doesn't care about narratives. It reflects underlying stress between real assets and paper claims. And paper claims are everywhere. Futures contracts layered on futures contracts. ETFs promising exposure without delivery. Synthetic positions stacked on synthetic positions. Promises built on promises. Meanwhile, physical inventories don't multiply. They drain. They leave vaults. They move into long-term storage. They disappear from accessible supply. When that imbalance grows too large, confidence breaks. Not slowly, suddenly. This is why the gold-silver ratio is quietly feared among professionals who understand market structure. It exposes fragility that price charts alone can't show. It reveals stress that headlines deliberately ignore. And we are approaching levels that historically mark the end of stability, not the beginning. Let me be very clear. This is not about predicting tomorrow's price. This is not about calling tops or bottoms. This is about recognizing a structural warning. Signals like this don't ring bells. They whisper until they don't. Once the ratio starts moving back toward historical norms, it rarely pauses halfway. It overshoots. Because positioning has to unwind. Because leverage has to clear. Because trust has to be repriced. Because reality eventually replaces distortion. That's when people suddenly ask the same questions every cycle. How did silver move so fast? How did this happen without warning? Why didn't anyone see this coming? The warning was here. Most just didn't know how to read it. At Vault Stress Report, we focus on signals that operate beneath the surface. The kind that don't trend until it's too late. The kind that don't show up on mainstream charts until damage is already done. And right now, the gold-silver ratio is telling a story of mounting pressure inside the global financial system. A system loaded with debt. A system dependent on confidence. A system that requires constant intervention to remain stable. A system where real assets are quietly being removed from circulation, while paper claims expand without restraint. Gold is being hoarded. Silver is being consumed. Paper claims are multiplying. Physical supply is tightening. That equation does not balance forever. As we move forward, watch how the conversation begins to change. Watch how silver suddenly starts appearing in headlines after years of neglect. Watch how analysts scramble to explain moves they didn't anticipate. Watch how the ratio compresses faster than models predicted. Watch how explanations follow price, never lead it. That's not coincidence, that's resolution. And when that resolution happens, it won't just affect metals. It will ripple into currencies, equities, bonds, and trust itself. Because metals don't move in isolation. They reflect the health of the system underneath everything else. This is why understanding this signal matters, even if you never trade gold or silver, because it tells you something fundamental about the structure supporting your savings, your currency, and your financial future. Now I want to hear from you. Do you think the gold-silver ratio is signaling a silver repricing, a currency confidence problem, or a broader systemic reset? Drop your thoughts in the comments. Vault Stress Report thrives on intelligent discussion, and your perspective genuinely matters. If you found this breakdown valuable, share it with someone who still thinks metals are boring or irrelevant. Sometimes the quietest signals are the most important ones. Stay alert, stay grounded. And remember, stress always shows up somewhere first. This is Vault Stress Report.